When we're looking at the first myth, the slowing growth is narrowing the opportunity in China. Just to begin with, I think it is inevitable to see a declining growth rate in China as China has become the second largest economy in the world. When we are looking into some absolute number, for instance, from 2005 to 2019, the GDP in dollar term, we're looking at 18 trillion RMB, growing 5.5 times to 99 trillion RMB in just 14 years of time. So looking at 6.1% growth on a 99 trillion RMB economy, it's still a massive number. And secondly, I think it is actually interesting to see the breakdown of the contributions of GDP by different sector, and there's a lot more to tell, where there you could, a lot of the investor would be able to find exciting growth story. In the last 3 decades, China actually has transitioned into from a very old economy-driven economy back in early 80s to 90s, as a primary sector-driven economy, into a more secondary sector-driven economy after China joined WTO, as a lot of the manufacturer exporters were actually benefiting from the economic growth. And lately, we're actually into a more tertiary sector-driven economic growth structure. As you can see from the bottom left-hand side of this chart, we're seeing the tertiary sectors are driving almost about 54% of the GDP growth in China, and that has been represented by services and consumption-related sectors. And also, looking at the bottom right-hand side of the chart, China consumption growth is looking at around 58% versus US 68% as a developed market. By saying this is, we're actually looking, the transition of the growth structural change in China, and investors, if they're able to identify the growth transition or the structure of the growth engines, we're still looking into a lot of exciting growth numbers, breaking it down to a different sector, such as the chart that I'm showcasing in the next slide. This is the 2021 expected earnings per share growth. Despite the energy being the top EPS growth sector because of the lower base in 2020, there has been a very consistent contributions or growth drivers coming from the tertiary sectors such as consumer discretionary, information technology, communication services. With that said, we're actually still looking at 20 to 30% growth despite the earnings downgrade pressures still persist. This has been a consistent image about how China sectors are driving the MSCI China index growth from an earnings per share growth perspective. So this is first thing. For the second myth, the Sino-trade tensions will dampen innovation. Just to begin with this topic, I would like to share this chart, which showcases how the global supply chain really in place in terms of how different countries are playing their role under the globalization. South Korea, for instance, they are the biggest chipset in-memory chipset manufacturer in the world, while in Taiwan is the #1 ranked in terms of integrated circuit manufacturer, while in the US, they are the #1 ranked IC designers in the world. You can see this whole globalization, they're interlinked with each other with a complicated relationship. Just looking at China, to a certain extent, I could agree the myth about the kind of like restricting their access to specific technology components will be a big issue for China. If you're looking at this chart, China actually consumes over 58% of the integrated circuit consumption of the world, and they're the largest, while they're actually having about 14% of this integrated circuit consumption that are domestically supplied, which means they're actually having a very low self-sufficiency rate. So back in 2018, this is a big issue for China. However, when we're looking into how China has responded, they are actually speeding up the process of localization of the supply chain starting from 2014, but this is actually speeding up in 2017 and 18, and even after the Sino-trade tension has gone up. This is the big fund set up to foster the domestic localization of supply chain. What that means is for every $1 commitment in the big fund, the local government will be subsidizing $3 of funding to help these corporates to set up respective component supply chain productions. These $3 could be coming in different form, not necessarily just in dollar cash term. It could be in a tax benefit kind of form, and also giving benefits such as lower rental on the land supply to these different manufacturers. So this is highly supportive by the Chinese government to speed up the localization. I would just still have to say it would take time for these localizations to happen, because technology supply chain is not something that you can make in one day. China is still lagging behind in terms of some of the very advanced technology component manufacturing, but it is speeding up. So going back to the myth about the Sino-trade tension will dampen the innovations, I think instead of seeing the damage, I'm actually seeing the speed up of the innovation in China as they are pursuing the localization of the supply chain manufacturing process. So this is the second myth. Going into the third myth, which is the market restrictions limit investment returns and liquidity. I think this is echoing what Joe has mentioned about the China market performance, which could address this myth. However, also looking from a different angle, China is under a very big kind of underrepresentations in the global emerging market index, as well as other major indices under MSCI China and FTSE, that the second largest economy in the world is only taking up 4% of the MSCI emerging market index. From this perspective, the MSCI China A-shares inclusion, which was announced in 2017, has a big role to play. The inclusion factor will be a multi-year process to have a full inclusion of China A-shares, and we're expecting about 10 years' time to have a complete full inclusion. However, when you're looking at the bottom half of this chart, starting from 2018 to 2019, it has attracted almost about 790 billion RMB flow into the China A-shares market by both passive and active manager. As this A-share inclusions continues, we expect there will be a continued steady flow in the amount of around 27 billion per annum for the next 6 to 7 years of time. So we actually believe this steady flow will continue to improve the return and the liquidity profile of China A-shares. But not only that, I think the MSCI A-share inclusion actually carries a very crucial symbolic value, that it increased the awareness of the China A-shares market to international investors. And the fourth myth that I would like just to quickly highlight is idiosyncratic investor behavior in China hinders investment. I think this is, to a certain extent, correct, that China A-shares market is a very different or separate market versus even the offshore China market or ADRs, simply because of the investor structure in China onshore A-shares market. Currently, the retail investor in China still takes up the majority of the daily turnover percentage, with over 80% coming from the retail investor. These investors are trading driven, very short term. I'll probably just say they are also very ambitious on return, so they're very news flow driven as well. And the second part of the investor structure is the increasing international investor involvement in the Asia market, thanks to the MSCI Asia's inclusion. However, a lot of the international institutional investor, perhaps this is just the first time getting into the market. They are ramping up their coverage in the market, and based on the flow that we have seen in the last few years' time, they are very concentrated in the index large cap or blue chips company in China, Asia's market. And this kind of investor structure actually create what we call a market inefficiency, and that gives some certain level of opportunity for active manager to deliver alpha. Looking at this chart in here, I have listed out the active manager performance versus CSI 300 index, which is an onshore Asia market index, which many people will reference to. In a different period of time, active manager, unlike the Western country or the developed market, they are actually able to deliver excess return. And we believe the diluting of the retail investor because of increasing international investor involvement will continue to evolve this market to become more fundamental driven, and active manager will be rewarded based on the change of this investor structure over time. And lastly, it's about the last myth, as the Chinese companies ignore non-financial dimensions. I think this is probably coming into a more ESG-related perspective about how Chinese companies have been evolving over time. In the last 24 months' time, I think it is actually very interesting about how the awareness of ESG-related matters has increased, not only on the corporate listed company level side, but also for buy-side managers or asset owner within the Asia region. And China in particular, this chart has showcased an increasing number of Shanghai and Shenzhen listed companies that they are willing to increase their reporting with the engagement and related ESG initiatives to the public. I think this is a growing trend that we're seeing very strong momentum. And as an asset manager, Value Partner has also become the UNPRI signatories last year. And we're actually seeing a lot more companies that have disclosed and really actively providing their pipelines and their plans on ESG-related matters. I would still like to say we're in Asia or in China, we are still at a very early stage for ESG developments, but definitely we're seeing a very strong momentum, in terms of the awareness and also the engagement by the listed companies in China.